All right, let's kick it off. Good morning, good afternoon, and good evening to everyone dialing in. It's my pleasure to welcome you all to CGAP's webinar on Behind the Scenes with Inclusive FinTech Investors. I'm Sai Krishna Kumaraswamy, and along with my colleague David Kruff, we will be your moderators for today's conversation. We're joined today by a fantastic panel of speakers. We have with us Christina Juhas, Managing Partner and Chief Investment Officers from Women's World Banking Asset Management. We have Christian Rumer, who's the Senior Investment Advisor from Bamboo Capital Partners. Ayodele Ogunoike, Senior Investment Associate from Goodwill Investments. Vadi Ovajori, Director from GSMA Innovation Fund. And Maelis Carraro, Managing Partner, Catalyst Funds. Now, we can't possibly do justice to introductions given their storied careers, so I would request our audience to kindly follow them on their socials to learn more about them and their work. Now, today's agenda is split into about 15 minutes of a framing presentation that David and I will kick off, followed by about an hour of moderated discussion interspersed with opportunities for Q&A. For some basic housekeepings, this is an audio broadcast. Attendee microphones will be muted. Please use the chat box to respond, ask questions, share your thoughts. Make sure that you select all participants when you ask questions so that you know everybody can see the question. And if you intend to ask questions for a specific panelist, please include their name. And the webinar recording will be shared to everybody who's registered. Now, with that out of the way, we'll kick off the framing part of the conversation. Now, for those of you who regularly tune in to CGAP's webinar on MSE financing, this statistic is quite familiar, but it's a point well worth repeating, that micro and small enterprises are a formidable force just in sheer numbers. We have about 500 million of them across emerging markets, and firms with 5 to 19 employees contribute to as much as 40% of net job creation in emerging markets, paving the way to improve livelihoods and resilience for people from low-income households. Even so, they remain woefully credit constrained. Their transformative potential is often stymied by their persistent lack of access to finance. Now, CGAP's estimate finds that the unmet credit demand for micro and small enterprises is around $5 trillion. Only 40% of their credit needs are met. Now, we must acknowledge that there are several market sizing numbers floating around, and depending on who is counted and what the methodology is, this number can change. And we can quibble around the challenges in estimating demand for credit from a largely informal sector. But the larger message here is that this is a very, very large number, and it has remained so for a very long time. Taking absolutely nothing away from the transformative impact that the microfinance industry has, it is still a reality that small businesses across the world continue to face challenges in accessing finance. It is in this context that CGAP developed hypotheses around the enabling role of technology. Now, technological advances like machine learning, artificial intelligence, big data analytics enable both business model and financial innovations that can improve access to finance for MSEs. Now, on the one hand, you have MSEs themselves who are adopting technologies to run their businesses, developing both digital data trails and digital capabilities. And on the other hand, you have disruptive providers like Fintechs who are pioneering new approaches to service MSEs. And you also have incumbents who are embracing digitization and transforming themselves. Taken together, what we see is the very, very early stage evolution of the next generation of MSE finance markets, where digitally enabled providers are providing affordable, responsible, relevant, and tailored financial services for micro and small enterprises. Now, CGAP developed these hypotheses based on both demand and supply side research in about 5 countries, including India, Kenya, Peru, Nigeria, and Indonesia. We spoke to nearly 400 micro and small enterprises, dozens of providers, both fintechs and incumbents, and investors and other stakeholders. And to make sense of this highly crowded, confusing, and often chaotic MSE landscape, we distilled it all to about 4 archetypes of technology-enabled business models that we believe have the potential to advance access to finance for MSEs. But we also went a step further. We decided to test our hypothesis on 2 of these archetypes by piloting innovative digital credit products with 5 fintech providers globally. My colleague David will now walk us through these different archetypes and tell us more about it.
Thank you, Sai. And allow me to continue now and briefly present that at a high level, an overview of CGAP's research on technology-enabled business models that have the potential to boost MSE lending. It will be brief as we want to dedicate most of this webinar to the panelist discussion. However, if we have sparked your interest, please access the link to our publication, The Promise of Fintech for Micro and Small Enterprises, which I hope Sai can place in the chat box very soon. CGAP's research is by no means fully comprehensive, but we do try to identify key trends in business models that are important for understanding the evolution of the MSE finance landscape. On a high level, these new models are able to tackle important supply-side barriers to providing MSE financing. Specifically, when a fintech scales, they can reduce the high operating expenses associated with MSE lending. Think of the high consumer acquisition and transaction costs relative to the small ticket size. The second is related to the credit risk uncertainty. Insufficient or inaccurate data combined with the lack of adequate collateral often makes risk assessment challenging. So to overcome these barriers, new business models reduce the reliance on brick and mortar branches through using digital channels, digital data, which is further enabled through the now widespread use of APIs. The potential impact on MSE can be seen on the right column of this slide. The fintech firm CGAP has analyzed fit into 3 broad categories. You have the pure play financial services, which are models where the core activity is focused on the provision of financial services. You have embedded finance, which are models where the core product combines financial and non-financial services. And you have market provisioning. These are fintechs that facilitate the digitization of other FFPs, the products, the services, the workflow, the operations. CGAP's research has focused on pure play and embedded finance models. But let me emphasize that this does not mean that these models are in any way superior or provide more potential than the market provisioning models. Both are equally important. In our research, in other research, like the extensive work the CGAP MFI digitization team has done, the importance of the market provisioning models are exemplified. Here, CGAP has identified 4 different models, or actually archetypes of models, as several submodels are grouped within these models. You can see these on the current slide. Again, the details of how they work, the potential benefits, dependencies, and examples are all in our publication. Those models that speak most to CGAP's interest, which is those that are currently have the largest ability to reach excluded and underserved MSEs, are data-driven lending and embedded finance, which is the focus of this presentation. So let's start with data-driven lending. These models primarily use digital trails, digital tools, and new and more efficient ways of data generation, and they offer multiple advantages. Digital transactions and ordering data, they can act as proxies for business cash flows and can provide a more accurate picture of the MSE's financial standing. There are software programs that can upload documents, scan, filter, structure, and analyze relevant data. They're digital tools that improve the speed and the ease of credit disbursement and repayment, offering more convenience, greater transparency, and more control on how loans are used. The way these data-driven models work are perhaps best exemplified through some brief examples. And as Sai already mentioned, CGAP has been running 5 pilots with fintechs for over a year now. And I'm happy to draw from our experience and use these pilots as example. So for the data-driven lending, let's start with KaleidoFin, which is an Indian fintech that collaborates with MFIs throughout the country. The MFI shares customer data with KaleidoFin so that they can offer their product Kaleido Cash, to MFI customers. Now, Kaleido Cash is basically an overdraft facility for the MFI clients, primarily females who are group members, which is intended for covering emergency cash requirements. These are funds which might otherwise have been taken from the business they operate. The underwriting is based on the MFI data and other data which can be pulled from external databases, and it's fully automated. KaleidoFin's field agents cooperate with the MFI staff as they introduce new product. Clients, they do need to download the KaleidoFin app, and then receive a physical and or virtual debit card, which they can use at any POS. Another pilot, iFinance, a digital lender, also based in India, they onboard its own clients using field staff, not really loan officers, but more client acquisition and data collectors. Now would be a good moment to mention that most inclusive fintech CGAP has spoken with deploy such high-tech, high-touch models, which allows them to serve the bottom of the pyramid MSEs, and often not requiring that they even have a smartphone. As is the case with iFinance, they offer unsecured working capital loans to entrepreneurs with zero or very thin credit files. Its agent only visits new clients or conduct post-disbursement visits. iFinance applies data analytics and modeling across the entire credit cycle, from analysis to decisioning, disbursement, monitoring, and even collection. All these tasks are automated and managed through a central credit unit. An interesting aspect of iFinance is that they use sector clusters. I mean, each business sector has a different credit decisioning model. So your Kirana stores, your tailors, your taxi drivers, your hairdressers, your cheesemakers, what have you. These clusters all have different algorithms supporting the company's credit decisioning. The third one in this category I'd like to briefly touch upon is Simplify. Simplify is based out of London, but active in East Africa. And that, like many fintechs we have seen, they have changed and modified their core product offering several times before finding its sweet spot. They are now at a stage where they're able to deploy their platform for multiple use cases, all related to supply chain finance. For example, in Rwanda, they collaborate with tech company that is digitizing the FMCG supply chain, and Simplify tailors to the cash flow needs of the wholesalers in the supply chain, providing a renewable overdraft, thereby freeing up liquidity so the wholesaler can increase sales. So they receive transactional data from the suppliers, which they score and then provide this facility to the wholesalers. Another supply chain finance solution they are currently building is related to providing the BNPL product to street food vendors in Kenya. After a successful pilot, Simplify will now digitize the solution and bring it to scale. Let's move to embedded finance. Embedded finance is creating significant opportunities for incumbents, real sector companies, and fintechs to provide both financial and non-financial services through single interfaces. These models are either finance-led or non-finance-led services. So once a customer avails a primary service, a secondary business line is added to complement the existing service. So digital payments, lending, insurance, etc., are added to non-financial services, or things like supply chain management, accounting, customer relationship management are added to financial services. And further, there's usually distinction between in-house embedded financial service providers and those that are partnership-based. Just to give you an idea how widespread embedded finance has established itself across multiple sectors, you can look at e-commerce companies that are providing payment and credit solutions for sellers and buyers through a separate financial entity. Think of Mercado Libre that cooperates with Mercado Pago and Mercado Crédito. You can think of ride-sharing companies offering debit cards, instant payouts, digital wallets. Think of the Uber, Lyft, and Grab, for example, or even financing for drivers to purchase their own vehicles, like Move does. There are sector-oriented sector-oriented companies and fintechs that have partnerships that allow fintechs, allow the small merchants to gain working capital financing, and there's software for more seamless inventory ordering and management systems. Think of Tienda Pago or Wasoko. There are companies whose main offering is non-financial, like accounting, bookkeeping, customer relationship management, and then financial services are added to that. You can think of Katabook or Boeka Warung. And there are also fintechs whose main offering is financial products, and then non-financial services are added to that, like in the case of Confio. So whilst there are really many examples I could talk to related to embedded finance, I will again focus on CGAP's pilot partners. Both pilots are actively digitizing the FMCG supply chain, albeit with a different approach. And Friends, which is operational in Indonesia, Philippines, and Vietnam. There are several unique aspects of the model that they deploy. First of all, it digitizes the entire supply chain from the micro retailer all the way up to the FMCG manufacturer. And Friends does not take over any part of the supply chain. As such, it can be regarded as an asset-light company with a very strong data platform. The buy now, pay later product, which they offer, is interest-free and on consignment basis. So basically, it's a de-risk product for the micro retailer. So rather than charging the micro retailer at the bottom of the supply chain, the company established profit sharing agreements with the wholesaler and receives a percentage of the consignment sales from the principals. So both this is possible as the wholesaler often sees a significant growth in sales, and sometimes up to 100% within 6 months of being on the platform. And principals see this as a unique way of introducing new and often slower moving but higher margin products to the end of the supply chain. And finally, on Friends, it's really worth mentioning that all the products being sold by the wholesaler are digitized and cataloged, irrespective if Friends has a working relationship with the brand owners or not. So this provides the micro retailer with a large choice when ordering good with Friends staff, which are delivered to their doorstep usually within 24 hours. Now, the last embedded finance example I want to briefly discuss is Boost. Boost is deploying its WhatsApp-based ordering platform with micro retailers across South Africa, Senegal, Nigeria, Ghana, and Kenya. Our pilot was with Boost Nigeria. In Nigeria, Boost they're improving the supply chain efficiency of Unilever's last mile entrepreneurs, also referred to as the Shakti woman. The initiative aims to empower women in rural and semi-urban areas to become self-reliant entrepreneurs. So Boost's objective is to take the benefits from a digital ordering platform one step further. From digital ordering, which includes price transparency, stock availability, doorstep delivery, Boost aims to provide business intelligence to the Shakti entrepreneurs combined with an inventory lending product, which can go up to 1.5 times of their usual ordering basket. So Boost offers data-driven insights to retailers, to the micro retailers, which can transform the retailer's order history into digestible insights and enable them to better understand the health and the pattern of their business. If successful, and it's still very much pilot stage, this can lead to improved business confidence, growth in retailer profitability, and higher levels of engagement with Boost's platform. Again, this was a very high-level presentation, supported by many examples. In the deck, there are more examples and much more detail. Thank you, and Sai, over to you again.
Thanks, David. I'm sure you all have lots of follow-up questions, and I'd encourage you to please, input them in the chat box. With that framing out of the way, let's go over to our speakers and try to get some of their thoughts. Christina, I want to begin with you. Now, Women's World Banking Asset Management historically has been focused on investing in microfinance institutions. But over the last few years, we also see a lot of inclusive fintech investments in your portfolio. We would love to hear your thinking behind that evolution. And could you point to some differences between these two different asset classes? And does investing in inclusive fintech require different skill sets? So how do your investment officers or how does your credit committee perceive risks differently from the MFI investments to your inclusive fintech investments? And if so, what do you do about those risks that you see?
Sure, thanks, Sai. That's a lot of questions, so I'll try to take them in turn without boring everyone. But yeah, you're absolutely right. When we first started, so Women's World Banking started its journey as an asset manager in around 2010. And at the time, and it remains so, our investment strategy is to invest particularly in women's financial inclusion around the emerging markets globally. So 10 years ago, when we launched our first fund, that did mean largely investing in microfinance lenders. But in 2020, we launched our second fund. And for the second fund, we have broadened our definition of inclusive finance and particularly what we wanted women to have access to. So that included not just microfinance lending, but also small business lending, asset and vehicle finance, affordable housing finance, and affordable insurance, largely. At the same time, in that era, of course, with an increasingly digital savvy customer base and business models, having digitally enabled processes and distribution channels had to be part of the solution. So for our definition of fintech, I guess we don't see it so much as a separate asset class, but as a very promising business model for enabling the distribution and delivery of those financial services to reach customers that we're trying to reach. And in some ways, for this second fund, any financial institution that we look at, even if they are brick and mortar, if they aren't using some form of technology to enable their businesses, they're unlikely to be competitive in the long term. So a digital strategy has in many ways become a gating item. So having said that, yes, there are definitely differences or challenges that we face, and we did need to get much more digitally savvy ourselves. I would say there's two areas in particular that challenged us. As a traditional microfinance lender, we really didn't have the capacity to evaluate the robustness of the tech architecture itself. And the second challenge that we really kind of had to get our heads around is how does digitization and fintech actually complicate the question of responsible lending and consumer protection. So how did we, obviously there were more risks than that, or challenges, but I think those would be kind of encapsulating the biggest ones. How did we therefore solve for that needed upskilling? We did expand our team to include some investment officers with specific fintech experience, but frankly, we also relied a lot on consultants for every engagement that could bring a very specific expertise. But we found over time that we really could shortcut some of that, or we refined our inquiry around those core concepts. And by that, I mean with the first challenge on evaluating the robustness of the tech architecture itself, we found kind of the best test was to ask the partners that are using the technology about the ease of integration. Because ultimately we found that client experience is the biggest indicator of whether that service is going to be valued. And by that, I mean, you can have a very fancy architecture and a very powerful solution, but if the client you're trying to reach can't plug into it relatively seamlessly and access it without themselves changing their processes or becoming much more technology savvy, then the value of that robust architecture is greatly diminished. Customers won't want it. So that for us is the shorthand to evaluate the tech. Is really, it's all about integration and accessibility. And then on the responsible lending side, I don't know if it's a shortcut but what boiled down to two key questions for us came down to client permissioning and data privacy. So the main thing we want to know is, as you're looking at these data trails that David described, or alternative sources of information, does the client from whom you're collecting that, are they not only aware of everything you're collecting, but have they provided explicit permission to collect it? So that for us is a clear line of inquiry. And then the other question is, and how exactly is that data being safeguarded and held private? And is it in keeping with law of the land, as well as in general, does the company have controls over it? To your last question about the key new risks, I think that fintech poses to the business models. There were two that we identified as basically very core, very key. And that is harder for a fintech versus the traditional bricks and mortar model to protect. The first is client retention, and the second is obsolescence. So on the first point, client retention, first of all, can the company very, very articulately say who the client is that they're trying to serve, that they're trying to keep? Is it the partner or is it the end user? And to the extent they articulate that, what is the value proposition to delight that customer and retain it, and the long-term value proposition? So that's one thing that becomes trickier when you're talking about a fintech than if you've got, a brick and mortar location-based service offering. And then that second question on obsolescence, is, largely, do you know the problem, the market failure you're trying to solve? Are you solving it in the best possible way? And how, are there moats around your solution? So that is another thing that I think is particularly challenging for me. So those are the key points I wanted to make to address your questions.
Thank you, Christina. Those were some very useful insights, and I'm sure that the fintechs in the audience have taken good notes and will be knocking on your door soon. Let's move on to Ayodele. It's a pleasure to have you on the panel. Goodwill has been active in the fintech sector for about a decade now, and I know from personal experience the value Goodwill has brought to its investee company, Musoni Services. I also recently learned that the same actually applies for Copia. So it seems you guys are an investor for the long term with a lot of support, but perhaps you can highlight in some detail, how do you support your investees? What range of financial instruments can you deploy? Is there also non-financial support available? And as a board member, can you actually work with your fintech investee, like brainstorm, or are you more of a governance role? A lot of questions on your plate. Go for it.
Thanks, David, and thanks to the CGAP team for inviting me to represent Goodwill today. You're right. We actually have about 6 portfolio companies in the financial services and technology sector. But one of the main things for us is, we're a really active investor and very hands-on in our approach. So from the early stage, I think we tend to invest from pre-Series A up until the Series C round. And so that means from the initiation or initial conversation, we're looking at, the strength of the management team and if the problem they're actually trying to solve is a real problem and where it sits in the value chain. So we work side by side with them, evaluating their strategy, looking for opportunities for value add with regards to their impact measurements, thinking about ESG, because at the early stage, it's not necessarily a priority or an understanding of how their businesses or their business model drives impact. And we also support with fundraising. So in the event that, a fintech is raising around and they're unable to fill the cap table, we often reach out to our investor network, our family investors as well, co-invest alongside us. And, our theme is patient capital. So we're always by the side of the fintech, weathering the storms, regulatory and macroeconomic storms as well. So that's the highlight on how we support our investees. It's a good question that you ask around, our role as an investor with regards to board membership and governance. We've tried to split that into 2 different ways. So we often take a board seat and a board observer role, and the board seat is filled by an independent individual, often an expert in an area that the company is looking to grow into, or a key weakness in the management team or the organization as a whole. And then the observer role helps with mentoring and just having an up-to-date understanding of where the organization sits. So we have monthly check-ins with the founder on a scheduled basis. And with regards to activity within the investee, the engagement increases. So always a phone call away, an email away with regards to thinking through strategy, evaluating opportunities, sense checking transactions and opportunities for growth with the company and the founders. We also don't stop on the founder level. We like to engage with the broader team. So post-investment, we like to speak to all management and junior staff as well, just to get an understanding of the company culture, to ensure that it aligns with Goodwill's way of investing, because we believe that impact just doesn't come from the end user as well. It also starts within the organization, and investing alongside companies is, you can, simulate it to a marriage. So we're there for a long term. Fund life is around 10 years, and we have to like and understand each other to be able to deliver value. So with regards to the range of investments or instruments that we provide, our preference is pure equity. But we do also participate in transactions through convertible loan notes. We also do safe notes. And we recently launched a fund called Papaya, which is focused on venture debt for MSMEs in East Africa, also looking to see more women-led and women-owned businesses in that segment. And yeah, that's all I have to say on the questions. Thank you.
That's very, very nice to hear. So when you invest in a fintech, it really becomes family. That's kind of how it sounds.
Exactly.
Okay, Sai.
Next question for Christian. Now, Christian, you've had like a very interesting career as a risk manager, investor. You've sat on several boards, and I believe you have your own fintech, Lana, a cloud-based credit management platform providing business analytics. Now, given these multiple hats that you've worn over the years, the question is that with inclusive fintech business models, most of whom target vulnerable customers who are new to digital, new to credit, is there a trade-off between building right and building fast? There is a sense that there's a pressure to develop the product sooner, go to the market sooner. How do you make sense of this? How do you approach this? And how do you evaluate the scalability of an innovation? And as you respond, if you can also tie it back to, the age-old trade-off between social impact versus financial returns. It only amplifies in fintech models, which are so much more easier to scale without necessarily having to build the basics on the customer end. So if you could reflect on that.
Thanks a lot, and thank you for having me here in the panel. And it was already interesting to hear my colleagues responding to various aspects. I will try to answer the questions, but also give a little the background here from my past. Yes, indeed, I started as a risk manager, also with Bamboo. We have one fund, our Financial Inclusion Fund 2, that was primarily fintech, but also in bricks and clicks opportunities in India and Indonesia, but also fintechs. 6 of the 7 initial investments are still alive, which is actually quite successful so far. There we have, classic equity investments. We also have debt funds that we manage, then competing with the different sectors, but we're also looking at MFIs, at fintechs for debt providing. So we have a quite interesting perspective. The company I created myself, Lana, is actually not a fintech per se, but it's built on on my experience around MFIs or banks going into technology. I think that the key aspect here is really what we're trying to achieve with technology, because the first couple of generations were primarily around efficiency and cost savings, but had very little, at least when we talk about technology within a traditional financial institution and MFI. I'm not talking to the fintech that has started and tries to occupy a specific niche, but let's say the traditional bank, the traditional MFI that went into technology, primarily the idea was cost-cutting efficiencies, not looking at the clients, not looking at all the effects, and very often this failed because it was not really bringing the benefits that anybody was hoping. You invested a lot of money, and you were still not competing with the fintechs because you forgot about your clients. And I think that's actually the trend where, at least from the traditional financial institutions, the universal microfinance institution that offers everything within a region has to go towards really a customer-centric approach. So how do I serve my clients well? How do I build my experience with a client? How do I know more about my client than anybody else? And that also then transfers towards the fintech companies. If I have a fintech company that is just trying to launch an app, a technology just to throw out a specific loan, this being a nano loan, this being just a regular banking product, and just has a new technology and has hundreds of thousands of dollars to burn in marketing budget, that's not very sustainable. That's just another idea that, yes, a certain technology can work, but I'm not delivering a value. And that's something that I think is very essential if you look at a fintech investment. What is the niche that they're covering? Is it indeed the wash client, the one who finances the last mile from the distributor of hygiene products? Is it trade finance that has its niche in agriculture space or in other trade or in a specific region? Is it a restaurant financing or a delivery service financing where there's really more than just the technology? And I think the technology, as CJ said at the end, the technology, you can assess that, and in the worst case, it gets redundant anyway pretty soon. But where is the authentic, real business model that you have a case, that you have a proprietary knowledge about the clients, that you know the clients, that you can work with these clients? Because again, when we look at the fintech development from, let's say, 2015 to 2021, it was extremely difficult to run a fintech against the wall. Interest rates were low, funding was available in abundance. Throwing out some money and hoping that it comes back was fine. We all claimed to have algorithms that were developed by MIT or Harvard graduates, which in the end turned out to be Mickey Mouse at best, yeah, because if somebody comes up from MIT and says he has an algorithm and his recovery rate is 85%, meaning a default rate of 15%, that's not worth your student loan, yeah, not at all. So you need to really have your authentic model, your authentic part, and really build something where you also can survive a crisis, where you can work with clients, where you can support the clients, where you can combine your business with an existing fintech. Most of these fintechs, not by choice, but by necessity, convert into, or not most, many of the fintechs, not by choice, but by necessity, convert into banking as a service. What is the real value added beyond your product, beyond your technology that is important, which also then answers the question around speed. Yes, of course, you need to be fast and you don't need to waste time, and your technology better works. But again, before you have something that just randomly replicates another platform, you need to make sure you have a business case. You have your client base, you can work with your clients, you can demonstrate to your investors also that these clients choose you not because you're the cheapest, the fastest, but they choose you because you provide a specific value added beyond that speed and accessibility. Maybe leave it like that for the initial parts.
Thanks, Christian. There's a ton of activity on the chat box and very, very interesting questions. So maybe for the next 10 minutes, I'm going to pivot to the chat box and feed some of these interesting questions to the panelists. One theme that I see emerging is that around gender lens investing. On the customer side, Jayashree asked, how do we make sure that inclusive fintech models don't perpetuate or exacerbate the gender gaps we already see in the traditional models? And we also have a question from Kindle that talks about what are the investor strategies to support gender diverse teams and more teams with women founders. Maybe I should begin with Women's World Banking Asset Management in the room, and then of course, all other panelists are welcome to chime in. Christina, I know you've already responded in the chat box, but it'll be great if you can elaborate a bit.
Yeah, I'm happy to get us started on that, and I'm really delighted to see the focus on gender. Our strategy in general is to backtest. So we do a lot of data collection, and we look at every single product that is offered by a portfolio company that we invest in, and then we gender disaggregate, okay, how much of that product is going to women versus men. Where we identify problems, and it's not just numbers, we're also looking at, for example, what is the average loan size that a male-owned SME would be getting versus a female-owned SME. And where we see problems then, or big differences, we go back to management, we go back to boards, point out the data, and we challenge them or ask them to basically solve for it. What's happening? Why is that happening? And I think gender bias has a lot of authors, let's say, and sometimes you don't know, which to tackle first, which are the relevant ones, but it's a process of just, for us, let's make sure that we're moving towards parity, and where we're not, let's focus on why not and starting to address those problems. And then there's a lot of devil in that detail of addressing problems.
Thank you. Ayodele, Christine, Mylis, Vade, any responses?
Yeah, I'm happy to jump in there. Hi, everyone. I think, besides what Christina just said, which is very true for us as well, especially with products that are mature where you can disaggregate gender data, what's really important for an investor that invests early stage, when you don't actually have a lot of data like ourselves, we invest at pre-seed, is actually to intentionally embed that intentionality of looking for gender diverse teams across all aspects of your process, and also intentionally set targets for yourselves. And I know many investors shy away from that because it adds complexity, and it's not as easy to then say stick to those targets. But without them, I think it's easy to forget that you've actually had that goal for yourself as an investor. So for us from the beginning, for example, at Catalyst Fund, we said we wanted to have at least 40% of the portfolio being led by women, founders, and co-founders. And today we're at 38% with our historical portfolio, and have raised our target, continue to keep the target at 40 and raise it to 50% over the next 2 years intentionally. And built in the way we assess the investments, the way we source, processes that actually allow for women to come forward more easily. So for example, we built relationships with organizations across countries that do focus on women entrepreneurship and fostering, for example, women entrepreneurship as a pipeline provider. We have tried to add a gender lens in our sourcing process so that the pitches that we receive account for the fact that women and men are different in the way that sometimes they pitch their businesses, and actually being realistic about that in the way that we then assess the companies. And then also, because we're, as a non-traditional investor, we have a very high and deep capacity for providing support to ventures, adding that gender lens in the venture building and technical assistance that we provide to entrepreneurs, both from a diversity and leadership perspective and how important that is to drive success at the business. And there's a lot of evidence and data points that show outperformance from diverse team and gender-led teams, as well as at the product level. So how do you actually improve this product to be more aligned with what women need? So you really need to have an holistic approach to this question, and I think there's no shortcuts. And look at it from all sides.
You. We have an interesting comment that advocates for the importance of ethnographic research, and Odile, I completely second, and I don't think anybody in the panel disagrees that a lot of what we know about customers is rooted in their specific cultural context, and ethnography has a huge role to play. There's also a question around the challenges of adoption of new technologies in non-tech savvy population. So framed differently, we have inclusive fintech models that can serve those who are digitally savvy, but also we have models that could serve those who are not digitally savvy. So the question is sort of, what are some of the challenges we see from like an investor perspective, and what are the instruments of support that we can offer? Are there embedded capacity building components? How do you think about building capacity to be able to receive these models? It's an open question for anybody to jump in.
Thanks, Sai. Wade from the GSMA, just to chiming onto that question, I think a great question. I think we do see that digital literacy is a challenge in some low middle income countries. And so we, with our approach, have invested in what we call mobile internet skills training as a toolkit, MIST. And we are seeing quite a number of fintechs actually apply that model in ensuring that not only are they driving financial literacy and training, but they're also helping with digital literacy side as well. An example in that case is a company called NCBuco, a fintech in Uganda that works with village saving and loans associations, which primarily target women. And a lot of the work that they did initially was around the financial literacy and helping digitize financial saving groups and make that more formal. But then they also recognize that actually there is a challenge around digital literacy. And so they adapted the GSMA's mobile internet skills training toolkit to ensure that they are serving that demographic. And that's actually proved very beneficial because that still opens up the gateway to also considering smartphone ownership and then improving, that and addressing that barrier. And it also has opened up the opportunity for digital loan saving products. So I think when you're at that stage, you have to really think about being intentional around your capacity building. So that's, I think, one of the ways. And I think we've seen quite a number of startups that we've supported on the fund adopt that process, adopt the providing capacity building in that way.
Thank you, Vade. Those are some very useful insights. I'd like to briefly ask one question to the investors. And I think that's a question which is on a lot of minds of fintechs that are participating, is when can you invest in me? So let me say it differently. Could you give some nice examples of very early stage investments you've done, or perhaps just say, these are our minimum requirements? Because, fintechs have a long path to break even often, and they require investment way before that. So let's hear some nice stories. Oh, that doesn't sound good.
I don't want to start because I think I'm one of the later stage investors. So happy to jump in. But I think, also, I will defer obviously to the earlier stage investors. One of the ways that when we might be able to go earlier is perhaps not with an equity product, but with a different type of financial product, like a convertible debt, etc. But even that, I understand at early stage, it's hard to take that on.
Yeah, no, because I'm asking because so many fintechs, the founders spend so much time raising capital, and it's so difficult for them that this is really such a burning question. If something else, maybe identify other investment projects that are not available but that should come.
If I may break a little bit a different approach here, because in line with what we discussed before about digital literacy, our primary purpose is still to service the target populations here. And if they are not digital literate, we have to accept that as a status quo. We don't have to accept it as the future, but right now, for the moment, that's where we are. Yeah? And the benefit here of traditional MFIs here servicing these clients is that in general, they are reasonably profitable, meaning they are generating the revenues to invest into technology. Yeah? Whereas the fintech, as we all say, we have the early stage, the seed, where we have no perspective of profitability, where we are, for all intents and purposes, making bets that some of them survive. The investment or the support of a traditional financial institution, MFI, venturing out to technology and then step by step actually following their customers as they become more digital savvy is something that might not be the best approach for an investor or for an equity investor. I acknowledge that. But from the perspective of servicing our target clients is not the worst of all ideas.
Those are some very wise words, Christian. Thank you. But this is actually a very good moment to focus a bit more on the accelerators, because obviously the early stage fintechs have difficulties getting fundraising. So what can you guys do about it? Sai, did you want to kick off this one?
Sure, and the accelerators in the room have been waiting patiently for a while, so it's time we brought them. Now, Vadia, I understand that the GSMA Ecosystem Accelerator Program really focuses on bridging the gap between mobile operators and startups, enabling partnerships that can bring impact for mobile solutions. Now, in particular, the Innovation Fund supports startups from Africa and Asia Pacific with direct grant funding, technical assistance, and connections with mobile operators. Now, can you give some examples of inclusive fintechs that you have worked with? And what is your approach? How do you select early stage fintechs to participate in your program? And it would be great if you can also reflect on some of the partnerships that haven't gone well and what you learned from them.
Thanks, Sai. And it's just to weigh in and share a bit of how we work. You capture really well the Ecosystem Accelerator, which was an innovation fund that was active from 2016 to 2020, and some of the examples that I'll share today will come from that fund. I guess more broadly in GSMA and what we call the Mobile for Development mission, we have run a number of innovation funds for well over a decade now and supported over 100 organizations, not all fintechs, but quite a broad range and innovations across utilities, humanitarian. And I think one of the things that we see is that even though we take a relatively sector agnostic approach, we see that financial inclusion is a strong driver and an enabler for a lot of the innovations that we support. And just to kind of provide two examples from a portfolio, one being relatively well known and established is a company called Twiga Foods in Kenya. Twiga Foods are a mobile-based supply chain platform for small and medium fruit and vegetable vendors. We supported them with a grant. So our main way of supporting the organizations that we fund is through a grant facility, so equity-free grant funding, and we provide technical assistance. And so we supported Twiga Foods back in 2017 to really digitize their agri-value chain. And also help improve the way in which vendors can place orders through feature phones and through smartphones. And they introduced a fintech application that allows the vendors to purchase goods on credit for 72 hours with zero interest. And so really what that did is really help ensure that the costs were lower for acquisition of produce. It really helped provide access to finance, and it ultimately helped improve the livelihood of the MSEs, because they were able to meet demands quicker. If you can consider FMCGs and how quickly that moves. And so having that window where you have zero interest, and often the repayment rates were very positive. So I think Twiga Foods is a really good example from our portfolio that we've supported. Another example would be in Nepal, which is more of a digital banking solution. So eSewa in Nepal, and their Fintech, which provides a payment service, the payment service provider, allowing users to make online payments, pay utility bills, receive money, and set up merchant accounts. And by setting up those merchant accounts, they actually were able to establish within an 18-month period, over 2 million GBP in merchant payments digitally. And I think that really helps to build up a solid credit profile for a lot of the MSEs. And so I think the journey that we take, I kind of say we're not a traditional accelerator, because we sometimes try to operate like a VC, but we're not a VC. We're really at that stage where we target the pre-Series A, C stage, and we really want to provide the grant so that the organizations can test innovation and see what has the potential to scale. And we support the organizations through an extensive monitoring and evaluation and learning framework. So we really want to help them set up our pillars around having a good theory of change, or a roadmap, as we like to call it. We also provide them with helping to understand how to set up their KPIs and measure that correctly, so that they can attract impact investment and follow-on funding. And we also, with our MEL framework, the insights that we generate ultimately helps them put together an impact report that they can use to target patient capital. So I know some of the investors on the call today, I'm eyeing up a few of them, because I would love to put forward our pipeline and our portfolio as potential pipeline for them to follow up and perhaps take to the Series A, Series B stage. And Twiga Foods, as an example, we reached Series C. We've seen quite a few of our portfolio go on to raise significant funding. Not a fintech, but you might have seen recently Bloomberg did a piece on e-fisheries, who are reaching unicorn status in Indonesia. I think how we do our selection process is we do a call for application two times in a year, where we set out and we publish terms and conditions and have objectives that we are sort of looking for. There's always a learning agenda that we are seeking to address with each fund that we announce, and we do it in 2 stages. So it'll be an initial pitch, and then after the pitch, we take our short list and we require them to provide a proposal. And at that stage, they're assigned a member of our team to work with them to develop their proposal, and that is submitted in front of an investment committee who makes the final awarding decision. And then we work with those companies for 15 to 18 months to really see what has the potential to scale, build up a sustainability plan, and hopefully and give them a lot of visibility. So GSMA has great platforms, being Mobile World Congress as an example, as speaking opportunities that we can provide to our portfolio, and also try to connect them with investors in our network. So I think quite broadly, that's how we support organizations through grant and equity-free grants and some technical assistance, and a few examples in there of some successes from our portfolio.
Thank you, Ade. That's very interesting. It's also very good to know that this webinar, and it's not even over yet, already has impact, as you promised to contact the investors on this panel to see where you can collaborate. I'm very happy to hear.
Maybe if I could just jump in, I was thinking as we were talking about the challenges of first early stage investors, and one of the things I think investors want to see these days in a way that maybe was different 3 years ago is not just about customer acquisition, but actually like a path to break even. And even as an early stage entrepreneur, if you can put something, even at a very high level, but could actually demonstrate that you're thinking to, when you become sustainable. And that's not necessarily a core competence for somebody who's trying to build a technology platform. It's actually not, so easy to do. But I was also thinking that there could be resources in market even. I mean, that's a classic, internship or business school project or something like that, that maybe there are other resources. Certainly there's a lot of technical assistance, grant funding out there to try to support entrepreneurs. It's sometimes hard to tap into, but if you can articulate like small pieces of a business plan that need help, that you can actually grant fund rather than equity fund, that might assist that tricky journey.
Yeah, no, I agree. And something that I missed saying earlier was that the way we apply the grant funding is not to fund the entire organization, but to fund a particular project. And so the organizations that apply to our fund will often have a project that they believe they can achieve within 15 to 18 months. But yet within that, our proposal stage, we look quite intensely at their roadmap to understand what outputs and outcomes will come from the project, and how this contributes to helping them be more sustainable, be it with break even, understanding their revenue. So revenue is generally a KPI that we track across all of the I say investments that we make at a grant level, unless it's a humanitarian focus initiative. But revenue is a kind of key KPI that we track across all. And so, yeah, I completely agree. And I think when you demonstrate that, then the idea is, okay, well, what does the path to sustainability look like? And, what type of follow-on funding do you need? Not recognizing that not everyone can run and go and get equity funding, but maybe they need different type of funding or concessional. We've been talking a lot to, not to name drop, but talking a lot to UNCDF around the build and bridge financing. And that often is a really important step for startups who are at that seed stage, perhaps getting bridge financing or getting funding from concessional finance from organizations.
Yeah, I'd like to add to what both Wade and Cedar have said. For us, we found that companies tend to lose focus and not iron out their unit economics. So just simplifying your unit economics and the roadmap in a way that you can reduce the customer acquisition, because once you have your unit economics in a profitable way, the missing piece is just the scale and the route map to growth. So oftentimes that's like the missing piece of the puzzle. And there's a lot of focus on growing the customer base, and they don't fine tune their unit economics to ensure that there's a balance there. But once there's a match, I think everything else, usually there's support from the investors, and looking again like your capital cycle, how much working capital is needed, and tapping into other networks such as grant funding or concessional debt. Now venture debt is a growing segment in the global south, so that's also a resource that fintechs in the early stage could tap into. But once you have the unit economics sorted, I think there's often a lot of buy-in and support to ensure that the vision is actualized.
Okay, thank you so much, Christina, for that intervention and for the extensive answers from Wade and Ayodele. I do want to move the attention to Mayalise now. Mayalise, I'm just going to read something that I took from your website, and then you can explain the rest, I guess. From your website, I've learned that for every USD invested, 86 was raised.
That's right. Mm-hmm.
That sounds incredible, but maybe you can, explain a little bit how it works and what this actually means. I mean, does this solve the problem that we're talking about?
I mean, it solves one side of the issue, but obviously, as others have highlighted, every company has to work on the fundamentals of their businesses and making sure the unit economics are strong, the customer is actually loving the product and is going to come back again and again, right, to it, and not just raising funds for the sake of burning it in marketing, right? So fundraising is one side, and there's actually many business models and funding sources that entrepreneurs can use beyond traditional VC capital. But to give you a little bit of light behind that number. So many in the room that I know may know this, but the Catalyst Fund is a pre-seed fund and accelerator that I co-founded 7 years ago. And our mission is really to back inclusive tech solutions across emerging markets. And we, at the very beginning, we had a strong focus on fintech that then evolved into more of an embedded finance focus. And today we're actually looking at the intersection of fintech and climate resilience. So how do we build a climate resilient future in emerging markets, particularly in Africa, leveraging fintech? And from the start, our approach had been built on the conviction that capital is only one side of the equation. And what really matters also, especially at pre-seed, right, we're like an extremely early investor, is support. Because most of the entrepreneurs, and this came from my own experience as an entrepreneur, what they lack is a team that has all the expertise that you need to get the product to product market fit, access to networks, access to investors, and much more, right? That it goes just beyond the cash. So from the start, we built a program that would aim to be the main sort of global platform for emerging market early stage entrepreneurs that would support with capital, but also very hands-on, bespoke, so tailored venture building support from a team of operators that can cover all areas of the business. So product, design, marketing, technology, sales, right? Everything that is so crucial to get right when you get started with your business. Fundraising is a key piece of that. But I think that the secret sauce for these results, so our portfolio so far has raised $800 million in follow-on funding. That's what has led to this 86x, right, in terms of the capital we put in. This result comes from the way that we've supported the founders from the beginning with this additional, really hands-on support that is offered to the entrepreneurs. So for fundraising, for example, specifically, like we make sure that we don't just do an introduction to an investor, but we prepare the companies to have the best possible data room. The decks are perfectly streamlined. The business case is really there. The data points and research that you need to highlight and what the users are saying, like feedback and validated the value proposition on the ground is included. So working on the fundamentals, and then making sure the introductions are always relevant. Like many accelerators, I think, rely almost too much on just a demo day or events for those connections to happen. But that disregards the fact that at the end of the day, it's a two-side street relationship. So the investors need to also be bought in and believe in the founders, believe in the team, believe in the product. And that happens when you do a lot of one-on-one tailored work also on the investor side. So we focused a lot on building relationships with co-investors. We have a circle of investors that now has 100 plus investors in it globally. And over the years, that work has yielded the results. But there's no secret that in order to support entrepreneurs, like what you need is time and resources. And we had the luxury to have the team to be able to do this. And yeah, really go deeper in that sort of fundraising support with each entrepreneur.
So really a lot of handholding from the beginning and really strengthening from the ground up. Would you say Catalyst Fund has become a kind of a seal of approval for the investment community, or is that too ambitious?
I'd love to say that. Mm-hmm. Maybe I'll consider my future marketing materials. So people do now see companies that have gone through us and see that they usually come out of it with higher quality. But it doesn't mean that we need to then take our model as assume that it works. So we always keep refining it and adapting it and making sure that we improve it and value for money, like in this case for entrepreneurs, is there and kept super high front and center for the team. So that's the main incentive for us is delivering value to entrepreneur, and we have metrics that we assess our work against that value. So NPS, Net Promoter Score from the entrepreneurs, is essential, and we always ask what they liked and did not like, how we could improve, but also then looking at the actual metrics in terms of team growth, revenue growth, fundraising, and are we actually moving the needle, like as an early stage investor, in increasing the outcomes or the odds of success for the companies. And that's tied to then the performance of our own team. So that alignment of incentive, I think, is also often disregarded, like in the accelerator world. And it's really key to so that everyone is really satisfied with the approach and the methodology.
Well, amazing work. Also from the Catalyst Fund as well as the GSMA.
If I may be so candid, actually, just to come in, I mean, GSMA have supported.
Floor is yours.
A few organizations that have come through the Catalyst Fund, so and they're remarkable organizations, and it's very interesting to see how well they have the venture building support has been extended to them. So I can only commend the Catalyst Fund for the work that they're doing. You definitely see the difference in the organizations that come through the fund. So I just wanted to throw that one out there.
Thank you, Wadid. We didn't even align. That's awesome. And likewise. And we partner, actually, to your point, David, we partner a lot with other accelerators like the GSMA. And I think that's only going to increase, and other investors here in the room. Goodwell and Christina and Women's World Banking are also part of the circle of investors. So, and that's key. At the end of the day, it takes a village for this work.
Yeah, it takes a village, and there's a lot more going behind the scenes in the village than people would actually realize then. This is all very interesting. It will probably lead to a lot of follow-up discussions behind the scenes, which would make me very happy. We have about 5 minutes left. Sai, would you be so kind to check if there are still Q&As from the audience that need to be addressed?
It's incredibly hard to keep track of the chat box in such an exciting conversation.
That's why I stopped.
I do want to acknowledge Jayashrie's comment where she says that the principal CFI outline in their paper on catalytic capital for digital lending resonates in many of the approaches our panelists have described. And perhaps as the CGAPs and CFIs of the world, there's nothing more rewarding when our working paper lives and breathes in practice. So I just want to acknowledge that. There's a very interesting question for the investors, but I suppose this is also for the accelerators. Now, how do you intentionally broaden your pipeline and reach deeper into the entrepreneurial ecosystem to get founders that might not easily get in front of investors? This, of course, is a huge problem even in advanced markets, right? So you have women founders of who are people of color, same when you extrapolate in the emerging markets. So how do we intentionally reach deeper? And how do we make sure that, we go to those founders who are probably not from the best business schools, who probably don't have access already? Curious to hear both from the accelerator perspective and the investor perspective.
From the accelerator perspective, we're just sharing from GSMA and past work and current work that we are doing and have done is we have engaged extensively with local tech hubs. We find that that works really well, and engaging and having a kind of a dual engagement where we have an ability to go and engage with the tech hubs and perhaps deliver some of our capacity building on how to build synergies with mobile operators and how the benefits of those partnerships or how those partnerships can be beneficial. And equally, there's a pipeline and kind of sharing of startups in that space, and that's a great way to kind of discover. So I think that has been something that we've been doing for quite a long while, and we continue to do. I think it's also, I think Mary's mentioned about, sort of being intentional. One of the ways in which, even though we do an open call for applications, so we don't go out and directly source, something that we introduced recently for our climate resilience and adaptation focus round was to request for nominations. So request for organizations to nominate founders, and that's also proven quite useful. And actually with those nominations, we then go in and have a direct conversation. So I think those are the kind of two approaches that we have adopted. I'd love to hear more approaches because I think it's just work that we should continue to do to make sure that our funds are reaching those who need it.
Yeah, totally aligned with Wade. One more that I'll add is relying on referrals from the network. So referrals from other investors that perhaps are seeing a great opportunity, but too early for them, is a great source of pipeline because, it's already sort of pre-vetted. And then as, your portfolio grows, alums, so other entrepreneurs are usually able to spot great quality entrepreneurs, right? They recognize themselves in others. That has also led to great recommendations to us.
Yeah, like Mali said as well, we rely on founder recommendations, but part of our biggest thesis is local teams because of the local context. So Goodwill has teams in all the regions that we operate in, and through those networks, we've been able to find, like-minded founders, and those that are often underrepresented. I also think active participation in those communities, so seeking out, events and going to, the roads less traveled, and also just embedding it in the thesis. So ensuring that it is top of mind for everyone, team members, investors alike, and ensuring that it is part of the company culture to be inclusive. I think that has really helped us in ensuring that our portfolio reflects that.
Okay, thank you. Thank you to all the panelists. I mean, such a vocal and active panel is really a blessing for Sai and myself and for CGAP. You made our jobs very easy. It was very interesting. I would love to do this again, not tomorrow, but sometime soon. Sai, any last words?
Just many thanks to our panelists for their time, but also to our audience. It's the middle of vacation season in the Northern Hemisphere, and yet we've had a very active audience, lots of questions. Now, there are lots of questions that have remained unanswered. I will share the chat files with our panelists, and as time permits, they'll respond. But thank you once again. The recording will be shared tomorrow to everybody who's registered for the webinar. Stay tuned for more from CGAP on this topic, and have a great rest of the day. Thank you all.
Thank you.